Let's go now to our friend Beimnet at BB from Galaxy Digital Trading. As always, my friend, good to see you.
Thank you for having me.
Big day today.
Absolutely.
Wednesday, February 1st. It's not January anymore. Wow, month two. New monthly candle started. The Federal Reserve, FOMC, I guess was the meeting today. Certainly they put out their decision on rates today. What happened?
Yes, the FOMC decision came out today. The Fed hiked rates by 25 basis points. They guided that they are likely to do more hikes in the future. Powell had a press conference as well after the statement was released. I think the press conference was fairly dovish, and the market is interpreting it as dovish. Essentially, he had to acknowledge the fact that the inflation data has started to turn. There are constructive developments in the labor market. They had employment cost index that came out yesterday. That was a little softer. And so there's a lot of things that are suggesting that you have sort of a Goldilocks situation where you have prices coming down and employment not ticking up that high. Unemployment
right.
Picking up that high. And so basically the market and the Fed kind of make it seem like Goldilocks is in really within reach.
It's in reach, the soft landing.
Soft landing, however you want to think about it.
Yeah, prime.
And then you couple that with an insane level of under positioning in risk assets. We're talking. I was telling you guys this on the floor, but you're talking about trillions of dollars that are defensively positioned. That all of a sudden, the world's most important central bank and the most important central banker basically gave you a green light to buy risk assets today. And
does he think that?
He knows it.
He knows it.
He knows it.
Yeah.
They're too smart. They watch the price action.
They know.
He basically, when he walked into the press conference today, he had a decision to make. Do I get so aggressive enough where I need, I try to take stocks down?
Yeah, like mean talk following a soft raise.
But he got asked a question about stocks. Literally, was the first question
ripping
asked
at the moment.
It wasn't that. It was
Okay.
I forgot the exact specifics, but it was basically financial conditions are easing. That's counterproductive to your goal of slowing down inflation. How are you thinking about them? And basically, he gave a nonchalant answer that, monetary policy works with a lag. They're monitoring, a number of things, and we'll see how that stuff develops. So essentially, he didn't take the opportunity to be no, stocks need to be 5% low. They'll never say that.
But he said something like that at a previous one.
Yeah, basically, a reporter in two FOMC meetings ago, I believe, told him that stocks and bonds were rallying during the meeting, and he proceeded to literally talk through 5 talking points about why stocks and bonds shouldn't
be rallying. Yeah.
And so there's a very different tone. You could tell that there was definitely a change, not a pivot, but sort of a movement along towards Goldilocks, soft landing, and less hawkish rhetoric. And you could see it not only in the text and what he's actually saying, but his demeanor, how he was thinking about inflation. The tone was just so different, right? It's really tough to appreciate these things unless you are a consistent follower. Mm-hmm. But markets don't lie. They're ripping like crazy. NASDAQ's up 3% here. We had some company earnings that were reported after the bell today, and stocks have only continued to rally thereafter. I mean, Bitcoin, as we speak, is testing 23,800.
Yeah.
And I think, this move probably has some more room to run. I'm thinking probably something along the lines of 4,300 in S&P. That's 150 plus points away. Probably at least 25K on Bitcoin. I don't even know where the offer side is on Bitcoin. Who on earth would be selling risk assets right now when the majority of the world's money managers are underweight risk assets and they're being told to buy them by the most important central bank? Why is there an offer on that? So unless you're taking profit. So I'm about as bullish as I've been, on a however scale you want to do it.
At least in the last several months, yeah.
Yes. Basically, the number one rule in markets is don't fight the Fed.
And the Fed is telling you what to do here.
Fed is they didn't tell you to sell stocks, which means you have to buy them. Because if you're not long it, you're short it. In my head, at least.
Yeah.
And the way I would describe it is, basically, you have every single person that's investing assets in the world looking at their portfolios today and looking at, holy shit, am I long the stuff that's been moving up the most? And the answer is, I'm not long enough of that stuff.
Yeah.
If you're a bond manager and you have, you have liabilities going out 10 plus years, and you're sniffing that the Fed might be slowing down or cutting, and you're like, oh my God, this might be my last opportunity to buy bonds on a 4-handle. Oh my God, this might be my last opportunity to buy bonds on a 3-handle. If you miss that opportunity now, it will cost you for decades to come. If you're a reserve manager,
you're buying long-dated stuff.
Yeah. Like the 10-year bonds can go from 340 to like 250 so quickly. So quickly.
Yeah.
And if you miss that and you're a huge bond manager, you're like, that's your whole job.
Yeah. You had one job.
One job, and that's to, buy bonds when they were reasonably cheap, because what have we known about bonds is they were in a 40-year bull market. They only go down. You're going to be hunting for yield in about a year and a half.
Yeah.
And if you don't get it now, it's like, and then same thing. It's like there's so many trades. Like everyone on the planet got long dollars last year and is still overweight dollars. And they're trying to get into trades like long euro or short dollar yen, and you're just not getting the opportunities. Like, I mean, euro is, I think, testing like 110 right now. You got Bank of England that's about to be hawkish tomorrow. Like, it could be a 112 by the end of the week, and you're a reserve manager that put all your money in dollars and you haven't twitched yet. And it's the magnitude and the pace of these moves are going to catch people off sides. I think, for me, keep it simple. Buy risk assets. Buy convexity in risk assets. And, it's time.
Wow, it's come a long way. I mean, we were talking, I remember us talking in June. You said you hadn't been this bearish in a long time. Then you got bullish in July. Then we've sort of been, trucking along here through the fall, which, in crypto had idiosyncratic events that impacted it. Bitcoin and ETH ran all of January, sort of like almost a reversion to where they should have been.
Yeah.
And you think there's still room to run?
Absolutely. It's just a simple function of like what does risk reward look like in these assets. If you look at Bitcoin, if it's floored at 20K, you are like 15% from 20K.
Is the downside?
Is the downside. What are you? Are you going to go short it to try to make 15% on an asset that has no upside?
And it was already down a lot.
It's already down a lot.
Yeah.
Like, what are you going to do?
Yeah.
And then at 23K, you're like, this is an asset that's traded at 68K before,
right.
And it's risk on. Like, whoa.
Right.
And then you're like, okay, what's been doing well this year? Well, Bitcoin's up 40%, has one of the best risk-adjusted returns out there. It trades over $30 billion a day, deeply liquid spot and derivatives market. Like, shit.
Should be on the radar.
There are people probably freaking out right now. And I'm using the PG words to it. Especially anybody that's in crypto world that's benchmarked to an index that is crypto, full crypto, no cash in it.
Yeah.
I bet you most people are underperforming because you couldn't have been full length or
you're not going to be
over-levered at the start of the year.
Basically all Bitcoin and ETH and some smaller
even
cap
alts,
stuff.
But still, if you're like measuring your returns versus the stuff, like you're underweight.
Yeah. You're
forced to chase here. You're a dip buyer.
Yeah. Interesting.
I mean, I think stuff's on the wrong handles. I gotta calm down.
It's a big day. It's your Super Bowl.
It is a big day, and like you have to remember rules and try not to get emotional. Like buying at the highs is normally a very stupid thing in markets, especially in mean reverting ones. But I have to say this does feel a bit different. You are taking out significant resistance levels and support levels in traditional markets. The brakes are there. The catalyst is there. That's all you need.
Yeah.
Like though all of markets really comes down to a chart and a story, and both of those things looking good right now.
Beimnet Abibi from Galaxy Digital Trading, as always, my friend. Thank you so much.
No problem.
Hey, if you enjoyed this conversation with Beimnet, make sure you listen to the full conversation on our Galaxy Brains podcast. Check that out at galaxybrains.io.